On Business Incorporated today, major central banks in Africa consider the impact of Russian invasion to Ukraine in making monetary policy committee meetings decisions. Nigeria's central bank holds a one-day monetary policy meeting. Decisions to be announced in less than an hour. Hello and welcome. This is a special edition of Business Incorporated. Thank you so much for joining us. I'm John Mekwa. But first, let's do the markets as usual. We kick off this edition with market numbers from major equities in Africa. Trading was mostly mixed at intraday. Nigeria's main index was down 0.15%, while South Africa's performance index was unchanged. Similarly, Egypt's EJX 30 was the biggest mover. It was up 4.56% at intraday. Meanwhile, Nairobi Stock Exchange closed Friday's trading session in the red. It was down 0.5%. Let's go to Europe now and see a little bit of what's going on there. After long talks and thoughts on how to reduce dependence on Russian gas, Germany has reached a deal with Qatar for long-term gas supply. We have Chelsea now to tell us the details. Hello, Chelsea. Well, the two sides appear to have reached an agreement. Can you give us some details on this deal?
Well, German Economy Minister Robert Habeck was in Qatar over the weekend negotiating this deal, which is going to be really a crucial part of Germany's strategy to diversify its gas supplies. That, of course, has become absolutely crucial as Russia's war in Ukraine threatens Western Europe's energy supplies. Now, Germany is one of the most dependent in Western Europe on Russian gas. It gets about 2/3 of its natural gas from the country. Qatar is a major player in gas. Last year, it was the world's biggest exporter of liquefied natural gas, so that's the type of gas sent by ship instead of pipelines, and it does have plans to increase production by 50% by 2027. So this deal could make a big difference in Germany's energy supply, but there are, of course, some major caveats. First, the two sides haven't said exactly how much gas Germany can expect to get from Qatar. Secondly, this will take time. Part of the agreement is that Germany will fast-track the construction of two terminals that will handle those LNG imports. That's something that will likely take a couple years. Both sides are talking about this as a long-term supply agreement, and that was a crucial sticking point for Qatar because they are also making a big investment in this. It's very expensive to produce liquefied natural gas, so they want to know that Germany is going to remain a big customer, not just today or this year, but for many years to come.
And what kind of impact is this having on the market where gas prices, have been very volatile in recent times?
Yeah, so we have seen prices for European natural gas coming down in the past several days after these really huge surges. Today, the benchmark natural gas price has fallen even further. So the fears over an immediate energy crisis here do seem to be easing, but only partially. So going into this meeting, the economy minister, Robert Habeck, did discuss how urgent the need is for more gas, how we could potentially run into trouble next winter if more supplies aren't secured. So as I mentioned earlier, this deal with Qatar is for the long term. It will take years to construct those LNG terminals through which Qatari gas will come into Germany. So in the short term, Qatar does have some LNG that can be sent to Europe, but it's only about 10 to 15% of its overall supply to the market. That could help, but Germany is definitely going to need other forms of supply. The economy minister has also traveled to the UAE. He's been talking to Norway. He's been talking to the United States. So the EU as well as Germany are trying to drum up more gas. Producers do seem willing to do that, and the EU has said it could get enough gas from other sources to replace about 1/3 of what it gets from Russia this year. But it will come at a cost, a very high cost, because many other countries, particularly in Asia, want that liquefied natural gas as well. So I'd say that means that these high prices we've seen for European natural gas, the benchmark contract is still up about 70% this year, despite coming off a bit in recent days. They aren't going to be going away anytime soon.
All right, Chelsea. Apparently, this is a conversation we're going to have many, many more times after this. Thank you so much. and enjoy the rest of your day. And a related issue going on in the UK, we have Juliana joining us now to talk to us. There are talks about rate cuts, and we don't have the details. Hello, Juliana. Good afternoon. What's that about?
Good afternoon, Innie. Well, on Wednesday is spring budget day, so the Chancellor Rishi Sunak will deliver the government's plans for spring for the couple of months. But of course, this comes at a time of mounting pressure, not just from the opposition Labour Party, but it's also coming from the public, from union bosses, and even some Conservative backbenchers, because we know that the cost of living is becoming a huge crisis here in the country. And this is even before next month, when we're expecting national insurance tax to rise by 1.25%, and also the energy price cap is going to be lifted by about 50%. So there are some suggestions that there could be some goodies in the Chancellor's red briefcase, and these vary from putting a stop to the rise in national insurance tax. Some people have called this the worst timed rise in tax in British history. Some economists are saying it's 50-50. The Chancellor could indeed stop that tax, but we know that the social care and the NHS desperately need the 12.5 billion that's expected to come out of that rise. But then, of course, people are struggling. I think the main thing we're all expecting, and the Chancellor has hinted over the past couple of days that it's likely to happen, is trying to remove some of this fuel duty. I believe at the moment motorists pay about 58p per litre in tax, but at the moment it's costing about £1.60 a litre, well above what it was a year ago because of what's happening in Russia and Ukraine. So we all have to wait and see. We know this government do like to leak some things to the media, and what we're expecting, at least on Wednesday, is there to be this 5p reduction in fuel duty.
Yeah, there'll be a lot of relief if that actually happens, Juliana. So what's going on in the markets at this time?
The markets are pretty good. I think investors in London are buoyed by the fact that the US President Joe Biden will be travelling into Europe this week. He's going to be having a meeting with NATO members, I believe, on Thursday. And then, of course, he'll be going to Poland. We know Poland have been taking the lion's share of the refugees that have been fleeing the war in Ukraine. So he will be holding diplomatic talks. That's cheered investors in the square mile. The all-share at intraday is up by 0.40%. The FTSE 100 also up by 0.62%, but the FTSE 250 is down currently by 0.63%. In the currencies market, the British pound also down today, down on the US dollar by 0.15%, also down on the euro by 0.22%, and down on the Japanese yen by 0.20%, Innie.
Oh, thank you so much, Juliana. It's a big day for us here. It's our MPC day. Thank you so much. Enjoy the rest of your day.
Thank you.
So we're going to have a lot of attention on the African continent. Global central banks, however, have shifted grounds to tightening phase to curb heightened inflationary pressures. This is on the heels of supply-demand imbalances caused by supply chain constraints, high energy prices, most of which are connected to the Russian invasion of Ukraine. Central banks in major African nations will likely raise interest rates in the coming weeks to tame inflation pressures that threaten to become entrenched. At the last MPC meeting, which was in January, focus was major for Africa, was recovery from the pandemic in the face of vaccine availability, shelf life, and hesitancy. But now, obviously, the major focus has moved from that, even though that is still a major factor. But the war in Ukraine is in the front burner now. The spillover effect of the war has led to volatility in global oil prices, with the attendant surge in energy and fuel prices, hike in commodity prices, dip in equities, and the threat to food security and value of commodities. Since the last meeting of committees in major African economies, the United States Federal Reserve has raised interest rates by a 0.25 percentage point, the first increase in more than 3 years, as it looks to address surging inflation, which remains at 40-year high. It was up 7.9% a year ago. Also, the Bank of England increased its interest rate to 0.75 in an attempt to tackle rising inflation in the UK. And that means that we're back to pre-pandemic. And now let's look at the specifics for African economies and their likely decision. This is this week and next week, actually, for a lot of African economies. Let's go to South Africa, where decision should be taken on the 24th. That's on Wednesday, 3 days from now. Rising oil and food prices will likely see an upward revision to the South African Central Bank's inflation forecast. It's expected to increase the benchmark rate by 25 basis points for a third straight meeting to avoid higher inflation becoming entrenched. The bank refers to anchor inflation expectations close to the 4.5% midpoint of its target range. The National Treasury has warned lawmakers that the surge in oil prices due to supply shocks could see inflation edge to the upper end of the central bank's target range of 6%. The biggest uncertainty, obviously, is oil prices, and that's for South Africa. And let's move to our neighbor in West Africa, Ghana. The Bank of Ghana is meeting even as we speak, and its interest rate is to stem a decline in the cedi, which is trading close to a record low against the dollar, and rein in broad-based inflation. That's a 6-year high. Currently, policy rate is 14.5%. Inflation rate for February stood at 15.7%, while inflation target is 8% plus minus 2 points. Then we move to East Africa. Kenya's MPC meets next week with inflation at a 16-month low, and within the central bank's target band, Kenyan policymakers will likely keep the rate unchanged for a 13th straight meeting as they assess the impacts of depreciation in the shilling and the spillover of effects of the war. Higher than expected price pressures from surging wheat and oil costs may lead the policy committee to revise its inflation forecast upwards. The net oil importer, in its latest monthly fuel price review, raised gasoline costs to the highest level since it started setting prices in December 2010. And then to a country that seems to be making the most of this time, Angola. Well, their currency is like the best performing against the dollar because of what's going on in Ukraine. Angola's MPC is also set to meet next week and is likely to keep borrowing costs steady as fuel prices and a rally in the Kwanza, the world's best performer against the dollar this year, help rein in inflation. Pausing will enable policymakers to assess the impact of global price shocks on items such as agricultural commodities, which are expected to have a major impact on inflation. And then we come back home. Economic growth in Nigeria is still at suboptimal levels, and the CBN is likely to buck their trend of undermining consumer price pressures to achieve their growth objectives. CBN has kept rates constant for a while now. Can't remember the last time we had a change in the rate. The war in Ukraine is, of course, a major factor that the policy will be looking at. The interest rate hike in the US and the UK, those will also be some of the other factors. Well, how has that have affected the average Nigerian so far? Well, we have in the studio to weigh in on this Professor of Economics and Public Policy at the University of Uyo in Akwa Ibom State. He's also the chairman for Economic Research and Training, Professor Akpan Epo, not a stranger to us. He's been here. Prof, good to have you again. Good afternoon.
Thank you for having me.
And then to speak on the real sector, how it affects them, the Chief Executive Officer of Transerve Disk Technologies and Transgreen Nigeria Limited, Mr. Cyprian Orakpo, also joining us now in this conversation. Good to see you, Mr. Orakpo. Good afternoon.
Yeah, thank you, madam. You're welcome.
Good to have you. So, Prof, we're here again, and one of the basic first questions would be, from January till now, how impactful has the decision that the MPC made to hold rates, how impactful has it been on the real sector, on business operations, on the financial institutions? How impactful has it been?
Well, thank you very much. The impact has not been so, in my view, so positive because the rate the MPL is supposed to have an impact on the cost of funds. But what we have seen is that it has impact on interbank lending, but in terms of cost of funds, there's no impact. The average lending rate is still about 25% or more. Okay, and as we speak, inflation is trending high. Unemployment is still very high, but at 3.3%. The exchange rate, the margin between the official rate and the black market rate is still very wide. So there's not been much impact. Except we've been told that, if I let me put it this way, the economy is still in a stage of stagflation. Okay? Now, I calculated what they call Economic Performance Index for Nigeria as an economist, and we scored about 65%. You need 80% to at least do well during that period. So
it's not like the PMI where you 50 is good.
Even the PMI itself, you know, we have to debate that to see whether we're actually doing manufacturing or whatever. But the EPI, which we call the Economic Performance Index for Nigeria, which I calculated, is about 65%. So we've not done well. Then what the economists call, some economists call the misery index, not the discomfort index. I did calculate that for Nigeria also with some adjustment from my own experience. We are about 8% misery index. So which shows that only about 12% of Nigerians are really doing well. When you look at the domestic constraints, and as you mentioned, the recent Ukraine-Russian crisis.
Okay, just before we go on break, let's get, I mean, from the real sector. I mean, maybe we're doing too much theory. Let's talk to Mr. Arapo now. Prof is saying that it doesn't look like we're doing so well when we look at the economy, the business environment. You are in it firsthand. How are we doing?
Yeah, I'm sure that Prof is actually saying it mildly. Okay, because the reality we have on ground might be worse than what Prof said. Okay, the economy is bleeding. The manufacturers, there is no worse time to be a manufacturer than now in Nigeria. It's not even just assessing the funds. You can assess the funds, but you are highly dependent on import of some inputs, raw materials, and some spare parts. And you can't access the foreign exchange at will. There is no, you can't predict. I mean, if we can access foreign exchange every 3 months, every 6 months, we can plan.
Okay. You know what? Just hold your thoughts, Mr. Arapo. We'll take a break, and then we'll continue from that foreign exchange issue, which, of course, has been a big elephant for so many months. We'll just take a break. When we come back, we'll continue with this conversation. It's a special edition of Business Incorporated here on Channels Television. Yeah, welcome back. Of course, you're still watching the special edition of Business Incorporated here on Channels Television, awaiting the decision of the MPC for the month of March. That will be the second for the year 2022. And then just before we went on break, we had Mr. Arapo sharing his thoughts, first-hand experience about what's going on. You were speaking on the issue of foreign exchange.
Yeah, I'm saying that there's no manufacturer, okay, that can make progress in his business if he does not have his hands on the variables. And one of the variables we have is foreign exchange. And he cannot determine how soon he can get the needed foreign exchange. He might have his Naira with him. And to a large extent, Naira is a problem to some businesses. But some businesses, even when you have your Naira with you, you cannot access the foreign exchange.
But there's been a lot of interventions by the CBN, the latest being the RT 200, you know, the $200 billion, you know, programs such as those. I mean, that started over a month now. Are you not feeling the impact of some of this intervention?
Well, it is good to have a good policy intervention. I mean, for the past 3 or 4 years, CBN has allowed banks to lend from their cash reserves at single digit, okay? But when they lend, So where would they get the foreign exchange? Because the important thing is to be able to access the foreign exchange for the inputs. Okay? Even like the CBN recent policy of 100 for 100, I mean funding businesses, 100 businesses in every 100 days. Okay? Even when CBN funds the initial capital investment, bring in the equipment and the machines, what about the daily need of FX? Okay? If even this is another area where CBN needs to look into. Funding the take-up capital, okay, providing the dollars for the importation of the machines is only half the problem, okay? These businesses are going to...
But is the dollar there?
No, CBN promised that the initial dollar for the importation of machineries, that they will make it available. I have not assessed it, so I don't know the reality, but I think it has worked for some people. But I'm saying that beyond that, okay, that you will still need dollars to replace your parts, the worn-out parts. You need dollars for some foreign inputs that are needed for the raw materials. Now, if you can't say when you can have those dollars, you are not a trader. A trader, if he does not have stock, he will close shop until he receives material. But a manufacturer, he has overhead that he must pay whether he is producing or not. And if you cannot have your raw materials within the time you planned, there is no way you can operate. This is the major problem that manufacturers are having today. And how CBN is going to sort it out with the banks, I really don't know.
Let's talk to Prof. I mean, they are they've been in this for a long time. They've been on MPC. They've been working close to policies and making policies. But, I mean, like Mr. Rapper says, it doesn't look like we lack policies. But where does the policy and the reality meet? I think that is the question here.
It's a rough time for manufacturers, no question. Especially if you have to spend a lot on imported inputs, very rough time. The problem is that is the foreign exchange available? That's the issue. You see, when the CBN says we can finance imports for 6 months or 3 months, these are provisional things. You know, they may not have the forex at that time, but they could make it available for certain sectors, in my view, like his own sector, for example. The manufacturing is a critical sector in the economy. In fact, to say a country is doing well, that sector has to contribute at least 40% to GDP. So if they are suffering, CBN should look at that sector and see how they can help that sector to acquire forex. In the medium term, in the long term, that sector itself should be able to begin to produce some of those things that they call capital inputs. Because over the years, our capital imports have not really, it's been increasing. In some countries, you import capital, you decouple, see what they've done, and over the years, you become self-reliant. But in the medium term, I think CBN should look at that sector because it's a critical sector. And that is part of our problem. They will tell you the economy is doing well. They were looking at the services sector, not manufacturing. So is availability of foreign exchange, I think.
But the RT 200 is supposed to push or encourage more...
Yeah, it's supposed to, as he has said, there are so many good policies on the table. But how they've been executed is another matter. And the CBN should do research and see why this is a problem. Even the so-called funds, intervention funds, are single digit in banks. People are still complaining about access. SMEs, medium-scale industries are still complaining about access. So they need to find out why. And the bottom line is that going forward, you have to have an economy that's diversified, that produces non-oil goods and services, and then export and earn foreign exchange.
Yes.
And don't depend on oil to have your foreign exchange.
We've been talking about diversification for
since I was born, although my age is now very old. So it's a big problem. So I can understand his plight. And that's why we say the economy is not doing well. Once that sector is not doing well, no matter the other indices, you're wasting your time.
Because that's the real sector that captures what the real sector.
Yes.
All right, so that's Prof. and Mr. Akpo, please Just give me a couple of minutes. We will have to bring an end to, the first part of Business Incorporated, but, there's a special edition. So we'll just take a break and close this curtain, and then we'll be back awaiting the MPC decision. Just stay with us.